You've heard it all before, right? Your equity allocation should be 100 minus your age. Gold, keep it to 5% of your portfolio tops. Higher the return, the higher the risk you need to take. This is the kind of investment advice we've all grown up with. It's been repeated in books, shared in forums, and handed down as gospels by self-proclaimed experts. But here's the uncomfortable truth. Most of this advice has absolutely nothing to do with the Indian market. So the question is, where did these rules come from? They're largely borrowed from Western models rooted in data from the US, mostly copied from legends like the Benjamin Graham, Peter Lynch, or Warren Buffett. While their principles are sound, they are primarily addressing the US audience. Their risk profiles, their tax laws, the currency stability that they have, that is all very US specific. But we are not in the US. So here's the real question. Should Indian investors be following advice designed for an entirely different financial ecosystem? Let's break this down a bit, right? The S&P 500 has been around since 1957. The India's Nifty 50, as you know, was formally launched only in 1996. The US market cap is over 50 trillion, whereas India's is roughly 4 trillion, just less than 10% of its size. The US equity ownership is deeply institutional. In India, the retail participation has just picked up steam in the last 5 years. So if we copy-paste US-centric asset allocation models into our Indian portfolios without questioning them, we risk building a financial house on a completely wrong foundation. Now ask yourself, has there been any serious India-based research that tells us what asset allocation actually works here? Backtested with Indian data spanning real economic cycles reflecting Indian investor behavior? Well, the good news is there is. One team has done the heavy lifting and they've done it right. The good folks at Capitalmind have conducted a fantastic multi-decade backtest using Indian market data to find out which asset allocation model actually delivers, not in theory, but in practice. In this video, I'm going to break down the key findings from this research, walk you through different asset allocation models they tested, compare their historical performance in terms of returns, risks, drawdowns, and volatility, and finally, show you which model came out on the top and why this could change the way you think about building your wealth. So if you've ever asked yourself what is the right allocation strategy for me as an Indian investor, this video probably is going to be a total eye-opener. So let's get started. The content shared in this video is based on my personal experience and is meant purely for educational and information purposes. It is not financial, investment, tax, or legal advice and should not be considered a recommendation to buy, sell, or hold any financial instruments. Please remember that investing and trading involves significant risk of loss, and past performance is not indicative of future results. Always do your own research and consult with a qualified financial, tax, and legal professional before making any financial decision. Now, let me ask you this. Have you ever walked into a financial planner's office and filled out one of those online risk profile forms? Chances are, within minutes, you're slotted into one of these three magical buckets: the conservative, moderate, and aggressive. But here's the problem, right? Most of the time, this categorization is done without any real understanding of you, your actual goals, your life situation, or even how you emotionally handle market volatility. You're just labeled. You hear things like, oh, you're 50, then you must be conservative. Oh, you've just started your career, you should be aggressive. You want to retire in 10 years, so let's make it moderate, right? Why? Where's the data behind this? Where's the nuance, right? These labels sound scientific, but they're often lazy, vague, and dangerously oversimplified. And more importantly, they are recycled from Western financial planning templates. They may have zero relevance to us, which is Indian investors. Because just think about it, right? A 50-year-old in the US might have access to Social Security, his 401ks, employee-matched retirement plan, and a fully functional, health insurance system. But what about a 50-year-old in India, probably still supporting family, maybe paying off a home loan, juggling rising health costs, and planning for the kids' weddings? So it's the same age, but radically different financial realities. So should they both be classified conservative just because they share a birth year? Of course not, right? This is how so many portfolios are constructed in India using templates that don't think, don't question, and definitely don't fit, right? And here's the kicker. Once you're boxed into one of these categories, your entire allocation gets dictated by it. You might be told, hey, since you're conservative, we'll keep you 80% in debt and 10% in gold and 10% in equity. Boom, your wealth strategy is already set. But based on what? A birthday and a gut feel? If you personally ask me, that's not advice, that's just guessing, right? And in a market as complex and fast evolving as India, guessing can be very expensive. So what we actually need instead is advice that's, number one, evidence-based, number two, backed by real Indian data, and number three, tested across multiple market cycles. And that's exactly where the Capitalmind research changes the game. The Capitalmind research has considered data going back up to 30 years. To keep the overall research a bit simple and straightforward, they've considered only four asset classes, which is domestic equity, which is Indian stock market. For the debt, they've considered bonds and FDs, gold primarily as a hedge, and finally US securities as well, so that it gives you that global diversification. So what they've done is they've built actually 6 asset class models. Starting with the first one called the token. This is where you're heavy on Indian equity. So 70% of us is in India equity, 10% on debt, 10% on gold, and 10% on US equities. The next one is called the textbook. This is the textbook allocation of say 50% on Indian equities, 20% debt, 10% gold, and 20% on US equities. The third one being the safety first, which is a very conservative portfolio of only 40% in the Indian equities, 50% debt, 10% gold, and you have zero allocation for the US equities. And the standard equal allocation, which is the 25% across all 4 categories. The Goldfinger, I was surprised as to why they considered this, because this is 50% domestic equity and 50% gold, and nothing else on debt or US equities. And finally, the Stars and Stripes, as the name suggests, it's 50% on Indian equity and 50% directly on US equity. And in addition to these six, they've also considered a seventh model, which is the Nifty model, which assumes that you invest 100% of your allocation into domestic equities. So they've taken these seven models and then backtested it for 30 years, and this is how these models performed. I think a couple of surprises here. The first one, the Stars and Stripes, came out on the top overall with about 16%. And the second big surprise is the Goldfinger. I personally did not expect this to come second in the list, which is the 50% gold, if you remember, 50% gold and 50% Indian market. That came as the second. And the other four, which is namely textbook, Nifty, token, and equal, pretty much all around the 14% mark. And Safety First, which is the most conservative model, which was very debt heavy, came at the last with about 12.3% overall. Well, the returns is only part of the story, right? I'm sure you definitely want to know how volatile these models were, and that's where we go into volatility now. Next, again, no surprise here, or no marks for guessing. The least model that had the least drawdown is the Safety First, quite understandably, and equal as well. And then textbook and token pretty much around the same category there. And if you consider the Goldfinger, the Nifty only portfolio, and the Star and Stripes, they all pretty had very steep drawdowns. So we've looked at the the overall returns. We've also looked at the drawdown data. Let's slice this up even a little better now, and then we look at the analyzed returns by allocation strategy. So they've given the data for 1, 3, 5, 10, and 15 years. So if you consider short term being like 3 years, mid term being 5 years, and then the long term being 15 years. If you look at the 1 and the 3 years, equal weightage portfolio has given much better returns of about 18.3. But this really being short term, can't pay a lot of we can't put a lot of weightage to this one. If you look at the medium term, Star and Stripe seems to have done slightly better than the equal weightage. But if you take the long term, it's quite interesting. Pretty much all of it at around the same levels. Only with the Stars and Stripes being slightly better. I mean, it has got a couple of points above the rest of the ones. That's an interesting observation, because what this tells us, which people have always been telling, in the long term, it doesn't really matter as long as you're consistently investing. Just 1 or 2 points here or there, but otherwise, if you really see, the overall returns doesn't really matter. I'm sure you have this question in your mind: what's the final verdict, right? What's the conclusion of all this study, right? So what the study did is they considered three main factors, which is the growth, stability, and diversification, and they put a score across all 7 models that they considered, and then what they concluded was the textbook style, which is 50% domestic equity, 20% debt, 10% gold, and 20% US equity, gave the most optimum performance across all 3 factors. Personally, this is the model that I'm currently following, although I'm going a little light on US equity going forward, because I feel that the overall edge there is lost. So I'm going a bit conservative on that. But overall, I'm basically sticking to this model for quite some time now. But if you are somebody who is very aggressive, the model also suggests that the Stars and Stripes, which is 50% domestic and 50% US equity, could be the one, because as we saw, it gave you a clear edge of about 2 to 3% more than all of the other 6 models. But however, the drawdown, as you saw, was close to about 60%. So if you are somebody who's kind of okay with that kind of drawdown volatility, for those aggressive investors, Stars and Stripes is what is recommended. And for the select few who are very conservative, who can't stand a lot of volatility, the equal weight, as we saw, was only about two points down from the highest returns, but that delivered that kind of returns with half the drawdown as the Stars and Stripes. So this is definitely not a bad choice at all. And that was the conclusion of that study. Given these conclusions were data backed, it gives us better confidence and peace of mind. Let me know what you think of the study and whether you agree with its findings. I'm sure some of you have different views, and I would love to hear that. So please put those in the comments. That's all I had for this video. Hope you like this content. I'll see you soon in another one. Until then, stay safe, stay happy. Thank you. If you genuinely found this video useful, please consider subscribing and liking the video. And I will see you soon in another video. And until then, take care and happy trading.